So, Mark, it's interesting when you take a look at all the different dynamics that the United States has been facing, and I say U.S., but of course Canada follows suit on so many fronts, just in terms of the closeness of the two economies and the dependency there. But when you think about the desynchronization of what's going on with the United States, and specifically perhaps because of the banking system and the aggressive Fed tightening. But then we look at Asia and we look at China specifically and the reopening there. How do we think about those two circumstances?
So what's interesting is that 2022 was a year for FX and like my big picture top down world. It was a world of momentum, and the momentum was kind of self reinforcing, which is you had this global terms of trade shock. That was a cost of living shock for Europe and Asia. Particularly, again, that's like the stagflationary conditions. U.S. was insulated. The inflationary shock basically was one, again, where countries that were importers of commodities realize a substantial loss of income, and it's what you call a dramatic terms of trade shock. So their central banks had extremely low real rates because nominal rates couldn't keep up with the adjustments in inflation expectations that you could use in break evens. That basically in the FX world comes through an inflation factor, in terms of trade factor, and then there was a carry factor, which was the US offered the highest kind of risk-adjusted yields. And as we're shifting out of global equity portfolios on the global stagflation concept, US dollar cash was king. The world has changed substantially since November, with a lot of upside surprises that no one was really anticipating. And again, China ripped the Band-Aid off in November, even after a very hawkish kind of People Party Congress, and basically said we're more pro-growth, we're focusing on easing, we are getting rid of zero COVID, and we're kind of reintroducing ourselves to the world. So China has kind of moved into a direction where they are the only country in the world essentially easing financial conditions. They are easing monetary policy, they're boosting the credit cycle, they're basically fine-tuning industrial policy. And while China is not going to have this big fiscal stimulus that offsets the slowdown in the US entirely, Europe is also coming out of a crisis where they didn't actually fall into a recession. And what we're seeing is what we track is global growth expectations and upgrades, and we feed those into our factor models. But what you're seeing is the global growth story has dramatically improved. So I think when you think about the transition, this year is more about mean reverting. This year is about growth and inflation balances. This year is about relative equity performance, because the dollar is, one of the correlations that I don't think people spend enough time on with the US dollar is you look at relative equity performance, dollar tracks it very well. So to me, the shift here.
Meaning, what do you mean by that?
So if you were to say like MSCI World ex-US relative to MSCI US, the dollar basically follows the correlation of if rest of world equities are outperforming the US, the dollar weakens. And if the US outperforms, and the dollar rallies. So that correlation has been very tight historically. It actually is better correlation than looking at front end spreads as a driver for the dollar. So I think what's important is that Asia represents a destination where financial conditions are easing. They are focused on boosting growth. No one has been positioned in these markets because of the slowdown that we saw last year. And again, the reopening of China, whether or not it's not going to drive the world for the next 2 years, but there's a huge delta that comes from the slowdown last year into the opening this year. And that provides acceleration, and that provides growth in a part of the world that offsets what seems like a very nice, or what feels like an aggressive slowdown in the US. So you look at relative yield curves, relative equities, relative growth, even valuations and positioning kind of favor this rotation. And we just put the trade on last night where we're long the Korean dollar versus US dollar. We're long the yen versus US dollars because these are all features of that.
Mark, are you actually seeing, though, institutions want to do that trade or that investment? And I ask you that in the sense, just looking at the political dynamics between China and the United States. I mean, there's to be fair, there's a number of institutions that don't want to do that investment these days.
I think one of the best ways to kind of guide that is through high frequency capital flows. You can look at ETFs, or you can look at data that records movements of equity flows. I do think that it's a question that everyone understands that you have to kind of take on the higher risk that these countries are kind of moving in separate geopolitical dimensions. But I think it's also quite clear that markets are still kind of looking for trades based on relative economic fundamentals. So our tracking of ETF flow data and equity flow data and things that you can map that into FX doesn't show that there's a significant shift.